G'day Internet, Max right here, and today I've got a very special guest who I met at an event recently. He's actually wearing the shirt from that event. It's called WebinarCon. It's a place where internet entrepreneurs go to meet each other and brainstorm and network and things like that. What I did there was I met Vadim Vos, and he was in my world. He's in the crypto world. He's doing something a little bit different than what I do, but it's a very, very interesting world. And I said, come on the show. I would want to pick your brain and understand more. Now, if you've been watching your emails, Vadim and I did a webinar just yesterday. So if you haven't watched it and you enjoyed the conversation that we have here, I highly recommend you go back and watch the replay. It'll only be up for a few days. So I'll put the link to that replay in the show notes in the description here on YouTube, or you've probably got it in your emails if you're a subscriber of mine. So without further ado, Vadim, welcome so much for being here.
Thank you, Max. Glad to be here.
Welcome so much for being here. That doesn't make any sense. Thank you so much for being here and welcome.
It works.
All right, Vadim. So, all right, let me introduce the topic. So, I've been involved in crypto for a long time, and what I would do is I would buy crypto and hope it goes up. Now, it's been a very good hope because it's happened, and it's made me a hell of a lot of money. No complaints. But in the last kind of 4, 5, 6, 7 years. Something that's come along called yield farming or earning yield from crypto. And that's much newer. And I must confess, I haven't paid as close attention to it as I should have. This is something that you've gotten involved in, which is an even extra special story because you've actually got, nearly a decade's worth of experience of trading. And you're like, trading, even with a decade of experience, that's a pain in the butt. I'm just going to do this yield farming. So that's kind of like, blew my mind. I think if you're at home watching this, I mean, think about this. This guy's got a decade of experience in trading. You've probably got 6 months, a year, 2 years, 3 years trading. And he's like, trading's the hard way. I'll show you the easy way. So all my spidey senses tingled. And I'm like, okay, I got to know more about this, at the very least for a portion of my portfolio. So Vadim, why don't you start by giving us a little bit of your background, just very briefly, because you cover this in the webinar as well, but just very briefly in about 60, 90 seconds, a little bit of your background and why you arrived at earning yield from crypto.
Yeah, so I mean, I became an entrepreneur at like 21, 22, so I've been doing that for like past 20 years. And in parallel, I was also into Bitcoin in from 2010, I think. ICOs, so I've been there since the beginning. I traded Bitcoin, Ethereum. I still do a little bit of trading. I'm not completely out of it, but I shifted most of my stuff to yield farming, which is much easier. It's like fully automated and you just get yield on your holdings, basically. That's it. You just kind of loan out your stuff to the traders. So I actually provide service to the traders, so they can trade. So I enable them to trade with liquidity and they just pay me fees. That's it. That's the simple kind of solution. And there's the different kinds: crypto lending and liquidity mining. So I do liquidity mining. That's kind of my specialty.
Okay, let me share the little that I know about this topic and make sure I'm on the same page. In the world of centralized exchanges like Kraken and Coinbase, they have a big pool of all of the coins they trade. They're sitting there in a big pool. And yes, they're matching buyers and sellers, but there's this big pool, and that's what creates the liquidity. And you're trading in and out of that liquidity, that big pool of funds. In a decentralized exchange, they need that big pool of coins that people are trading in and out of as well. Yep. They source it from the market and say, hey guys, come and stick your coins in our pool. We need it. We allow people to trade. We charge them fees when they trade, and we will pay you when they trade a portion of those commissions so that you guys are making money as well. And so you're incentivized to put your coins in those pool, and you actually earn a percentage of the fees that the decentralized exchange charges when people are doing swaps in that decentralized exchange. Is that a good summary?
Yep, that's exactly right. I mean, they basically crowdsource the whole process. Like Coinbase and Kraken, they have professional market makers, like large firms, or sometimes they do it themselves. They have their own pools, and they kind of keep all the fees. So they take all the money. They make all that profit. See, DEXs, they crowdsource it, so they allow us to make those profits, basically, alongside them. So that's how it's done. It's great.
Okay. So at a high level, I get it. So now here's where I think your expertise is really going to shine is, okay, how do I maximize the earnings and the yield that I get from the coins? So let's start at this spot. I need to hold I need to. I'm holding the coins. I'm lending them to the protocols, to the decentralized exchange. If the value of those coins go up or down, I am benefiting or suffering from that. But
Yeah,
while it's in there, I'm earning a yield.
yeah, for sure. I mean,
Okay, cool.
you could make money also on your position on the funds that you're loaning out, you know.
Correct.
If you're providing liquidity for like Bitcoin, Ethereum, and both Bitcoin, Ethereum go up, your position value goes up as well. Plus, you get the fees on top of that. So it's like
Understood.
I call it double dipping, triple dipping. You know, you make money on the on the appreciation, you make money on the fees, and a third one, a lot of those dexes give you incentives, like what's called liquidity incentives, which is rewards in their token, the other tokens. So you're getting three kind of sources of profit instead of just one, just holding. Like most people do. They just hold and hope it goes up. Why? If you're holding anyway, you might as well make money off it. Duh.
And I think, and I think this is the secret sauce, right? Because crypto is very volatile, especially
Yeah.
as you go down into the altcoin world, you get even more volatility. So if we'll get to what the yields are in a minute, but let's say you're earning a yield 5, 10, 20% per year per month. We'll get to the numbers in a minute.
Yeah.
But the value is going up 100% or down 100%. The yield in some cases, let's say in some cases, maybe most cases, we'll get to that in a little bit too, is not worth the cost of holding the coin in a down market. But if for someone it's like, oh, I can earn a 20% yield. It's a fantastic yield, but you might have to hold an asset that is volatile, goes up, goes down, might wipe out your gains that year, might not be appropriate for those people. But if you're the type of person that you already enjoy crypto, you already enjoy a particular token, you already want to hold it, then I don't really see the downside of earning the yield at the same time. You want the exposure, and then you can also earn a yield. Have I got that right?
Yeah, yeah. I mean, especially if you hold it when it goes up and down, unless you exit the position, it's only permanent loss or gain, right? It goes up and down. You exit when you exit, that's when you lock in your loss or gain. And obviously, why would you want to exit when it's at a loss? I mean, that's just dumb. You kind of hold it. Like I advise my students to always hold it until you're in profit on the main position, and you collect the fees on top of that and the reward incentives. So you can make money in all of those things. Yeah, that's what
Uh,
that's my strategy.
Okay, okay, I like it. So it's basically free money
Free
if
money.
you were going to hold the coin anyway.
Yeah, you're doing it anyway. You
Okay.
might as well provide it as liquidity to the traders so they can trade and take all the risks instead of you. That's what I kind of write. And I'm like, why would I want to take all the risk when I can just provide a service to the DEX and get paid fees for it? And that's
Yes.
it. You know?
All right. So now there's nothing free in life. I've learned that. So if I'm earning a yield and earning these liquidity rewards, I know there has to be some kind of risk introduced into the system. Help me understand that risk compared to I buy the coin, I stick it in a paper wallet and wait a few years for it to go up. Instead, I'm lending it to a decentralized exchange. Help me understand some of the risks that I'm involved. Am I giving up my private keys? Is there protocol risk? Take it away.
No, I mean, obviously, there's always risk in crypto. Anybody tells you different, run. That's a scammer. Don't listen to that guy. But if you choose a proper DEX, that had multiple security audits, that takes care of that risk, right? If they have 3 or 4 independent audits, like the DEX that I promote, StellaSwap, they had four independent audits of everything, their code, smart contracts. So, and they've been around for like 4 or 5 years and no incidents, right? Plus, they have a bug bounty, so you got to look for that. That takes care of that risk. Another
So hang
risk
on,
is
hang on.
yeah,
So
go ahead.
let me slow that down. Slow that down. So this is one
Yeah,
type of risk. I'm going to call this protocol risk.
protocol risk, yeah, like
The
DEX risk.
decentralized exchange, right? You put your money in there, and you're giving your money to a protocol, not a human, not a bank, not a government.
No,
And so
protocol,
here's the magic source of that: you never give up your private keys.
never
So there is it's not a third party risk, but it's a protocol risk. You're giving it to a
protocol risk.
protocol, not a person. A person can get hit by a bus, a person can run away with it, a person can do whatever. The protocol, if it's open source code,
Yeah,
has been around for many, 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 many years and has proper audits
audits.
done with open source code,
Yes.
and they have bug bounties, which for those of you who don't know what that is, what these companies do, they'll say, I'll give like a $10 million reward if anyone can come in here and show me a way that they can steal the funds or my customers can lose money. And if you, rather than someone doing that and stealing the money and then living on the run from the law
Yeah.
for the rest of their lives, maybe they could steal $100 million or $1 billion, but now you're on the run for the
Mm,
law for the rest of your life. What they do is they can go, well, you know what? I'll take $10 million. I can live with myself. I haven't stolen anything. I'm not on the run from the law, and I can live a good life. So
yeah.
that's what a bug bounty is for those of you who didn't know what that is. So if you've got those 5 things, that is a huge step towards mitigating. I won't say eliminating. That's too strong a word, but mitigating the risk of protocol risk. Is that a fair assessment of protocol risk?
Yeah, yeah. Especially if it's like secured by some big blockchain like Polkadot, for example, which is a top 20 blockchain, been around forever, crazy audits there. So Style Swap is on Moonbeam, which is secured, which is a parachain on Polkadot. So it inherits the security of Polkadot, which is like top notch. I would say it's the best security in the world. Probably even better than Ethereum. Although I love Ethereum, but Polkadot, takes it tech-wise for me. Yeah, so
Okay.
that's takes care of that.
Oh yeah, that's a very big. Okay. That's protocol risk. Are there any other risks we need to know about?
There was one risk, but that's eliminated, which was a bridge risk. As you know, for example, if you're, bridging over a stable coin from, let's say, Ethereum to, Moonbeam, and then, that bridge gets hacked, right? Because the bridge just issues you a token. See, but that risk is gone. That risk is poof, disappeared because now they're using native stable coins on Polkadot, USDC, USDT. So now it's native on Moonbeam. There's no more bridge risk, no more bridges. They only use like a squid router, which is a router which basically just throws like exchanges the token. So you get a native token, USDC or USDT on Moonbeam. So that's it. That risk is gone. That's the
Gotcha.
second risk. It used
So
to be
there's
there in the beginning, not
let
anymore.
me, let me say that back to you, make sure I'm understanding it.
Yep.
There no longer do you need to use wrapped tokens. You can use native tokens. Is that correct?
Exactly. Yeah.
Okay, cool.
It's
So that
native
was a risk,
Polkadot
no
tokens.
longer a risk.
No
Okay.
longer a risk. That's gone. Like XCM protocol is super strong. I mean, instead of like a wormhole USDC, now it's like USDC.XC, which is the XCM protocol. Which is
Okay.
native. Yeah, it gets
Okay.
minted Polkadot straight from Bitfinex, straight from the CEX. No more bridges. And that's it. And
Okay.
you just use that. So I always recommend my students to use those native stable coins. Always. Don't take
Okay.
bridge risk. Why would you do it? Like makes no
Okay.
sense.
Okay, gotcha. So there's protocol risk, there was bridge risk, which is no longer a risk. Is there anything else?
Gone. And the last one is just the basic risk of impermanent loss and permanent gain, but that's just like a risk of any coin. And if you don't want that risk, you could just invest in the stable coin farms, and there's no impermanent loss or gain. It's always $1. It's stable. I call it like a bank account equivalent. If you
Yeah.
provide liquidity between like a farm of USDC, USDT, you can still get 20, 30% risk free. Risk free in that sense, obviously. There's always protocol risk and whatever.
Yes.
But yeah, so there's always that choice. A lot of people are like,
Okay.
oh, I don't want to take any risks. I'm like, okay, stablecoin farms are your friend. Like, just do
Okay.
that. There you go. Which is
Okay.
still not shabby. 20%.
Okay. So let me slow. Okay. So that was it. So of course there's the protocol risk, but as we kind of covered, well, as I covered at the top of the show, this is for people who want the capital gain and capital loss risk. You wanted the exposure to the price. But then now you're saying
Yep.
if you don't want that, and I hadn't thought about this, you can go and grab stable coins and still
Yep.
get really good yields. Now you're no longer exposed to that risk. You're only exposed to that stable coin risk, which is, again, that's a whole other conversation, but that's been around for a long time and it seems pretty managed. Okay, this starts to become really, really interesting. I understand the risks now. Now tell me about the potential upsides. Is there a rule of thumb for how much yield you can get? Is it different yields for different categories of coins? Talk to me about how much yield I can get in the different categories.
Yeah. So usually there are like 3 buckets of farms. One is the one that you discussed, which is stablecoin farms, which is like no risk, bank account equivalent. You can get 20 to 30% on the native USDC, USDT. So there is no bridge risk, no price exposure, basically, and you just collect your gains, right? Then
So,
if you want
so
more,
hang
I
on,
got
slow down for me. I want to stick with that one. Just so I understand. When you say 20, 30% gains, you're talking per annum.
yeah, per year, APR, yeah,
Okay,
not
20%
per
per year.
month,
I just wanted to make
obviously.
sure. I just wanted to
Yeah.
make sure. Okay, cool. All right, so the second bucket.
Yeah, the second bucket are the blue chips, like Ethereum, Bitcoin. If you're already holding those coins, which are, top 10, let's say coin like Solana, any of those top coins, you're already kind of exposed to the price anyway, right? The only thing that changes when you provide liquidity is the balance between the tokens, in your holding. That's it, right? But you're still holding the same 2 tokens, Bitcoin and ETH, right? And you get like 40 to 60% per year now on those coins because they're not stable coins, right? And there's more volume and there's higher fees, obviously, so you get more fees. There's more volume usually on like big tokens. So that's like 40 to 60%. And just to kind of add to that, you can also make more by concentrating your position, which is basically the newest thing now, concentrated liquidity, which is before they used to provide liquidity for 0 to infinity, right? That was the old way, the V2. The V3, you kind of concentrate your position in a certain price range, right? So if Bitcoin is trading between, 90,000, 95,000, that's what the traders are using, right? That's the price range that they're using. So you just provide the liquidity to that same price range. Bitcoin from 90 to 95. And then you collect even more fees because your whole capital now is super efficient and utilize it 100%. So you actually can, and you can control that. If you make a wider range, you get less, APR. If you concentrate it to a tighter range, you get the maximum, I mean, you can get like 1,000% a year, right? But there's always a chance you're going to go out of range. And then you're not collecting any fees, if your range is super tight. But I cover all that. I covered all that in the workshop.
Okay,
Yeah.
that's that. Okay, so that there's an optimization strategy. I got my head around that, but I don't want to go
Yeah.
down that path just yet because that's a little bit in the weeds for me. And I think
Yeah, that's advanced. That's advanced strategies.
you explain that. Yeah, you explain that in your product, so we can leave that there.
Yeah.
But relatively easily, you say you can get 40 to 60% on your Bitcoin and Ethereum. But I do
Yep.
want to qualify something. You said your balances change. Let's say
Yeah.
I show up and I've got 1,000 Ethereum and 10 Bitcoin. Am I putting them in together or are they separate transactions? Explain this concept to me.
You basically, when traders trade, right, in the pool, one token gets exchanged for another based on the price of that token at that time. It's this fully automated. It's called AMM, automatic market maker. That's the mechanism that they use on DEXs to kind of balance the liquidity pools, and that's it. So as the price changes, just the balance changes. Ethereum to Bitcoin balance in the pool changes with it. But the value pretty much stays the same. And then so yeah, that's that's how you explain it in a way. Yeah.
So,
So basically,
okay.
it concentrates towards a less, valuable asset. So for example, if the price of like Ethereum, goes down, then there's more Ethereum in the pool than Bitcoin, and vice versa. Just to explain it very simply. You know.
Let me say it this way. When I put my coins in the pool, I am effectively buying a percentage ownership of the pool.
Yes. Exactly.
As the price changes, by definition, one pool of coins must get bigger, one pool of coins must get smaller.
Yeah.
And when
That's
I
it.
exit my position, I take the same percentage of the pool, but the raw value may be different, may be off,
Yeah. Yeah. That's an
maybe up or down.
impermanent loss or gain.
That's
Because it's
called an
not just loss;
impermanent.
it could be gain as well.
It
It
could be a
depends.
gain as well.
Yeah.
Uh, it could be a gain, or doesn't it by definition need to be a loss? Isn't it by definition a loss?
No. Basically, if for example you get into a pool at like the depth of the bear market and both assets are at super low prices, and then
Yes.
both assets in that pool pump, it's going to be worth more. That's impermanent gain, you know. And
Gotcha.
loss and loss basically happens impermanently. Once again, this is all impermanent. Until you exit the pool, this is all virtual. It's kind of like if your stock goes down or Bitcoin goes down to 40, but you didn't sell, and it goes back up to 100, did you really lose anything? Not
Right.
really. You
Not
just
really.
kind of held. It's the same concept there. There's also impermanent loss in trading, right? If you hold your position, it goes down. Oh no, I'm at a loss. Not really though. Hold further, it goes back up. Now you're at the permanent gain, aren't you? And until you sell into stable coins, your position, that how traders do, then you lock in your impermanent loss or gain and you make it permanent. That's how I always explain it to traders, when they're like, oh, what
Gotcha.
does that mean? I'm like, come on, you know this concept. You face it every day as a trader. It's the same thing.
Gotcha.
It's just with two tokens instead of one. That's it.
Okay, now let's talk about the third bucket.
Yeah, the third bucket is like smaller cap coins, So if you have some coin or two coins, which is even more than, right? Which is a lot more risk because they're more volatile than like Bitcoin and Ethereum, right? Like those like small caps, like basically, 100 million market cap or below, then you get even more, it's more volatile, but you get a much bigger return because the projects usually incentivize, their coins with liquidity. They deposit some liquidity into the DEX. in their own tokens. So you get their token on top of whatever DEX gives you, you know? And yeah, so it's just more volatile, like more risk, more reward, like everything else in life. More risk, more reward. That's
And
just that's how it works.
and so what is the reward for that third bucket for the low caps?
That's pretty much unlimited. I mean, it goes up from 100% a year to 500% a year. And if you squeeze the range tight, like you provide very tight price range, liquidity to a tight price range on that token, you can get 1,000, 2,000%, you know? Sometimes you get crazy volume spikes and you get like 3,000% in a week. You know, I've had plenty of that. And I screenshotted that and I showed it in my workshop, and a lot of people don't believe it until they actually get one of those themselves, and they're like, "Oh, okay, I guess you weren't lying." I'm like, "Yeah, that's what I was trying to tell you." You get
Okay,
those.
you
They're
get
not
that.
like super rare. You know, that's when you get that K at the end of the, of your APR. It's like, what is that K? I'm like, that, my friend, is 1,300% that you're getting. That's what that K means. They're like, "Oh, great! It's like winning a lottery or something." I'm like, "Yeah." You don't get that for too long, though. You get that for maybe 3 days, 4 days, a week, but that's still a lot of money. Even if you're
Yeah.
collecting, 1,000% for a week on your position, that's some nice cash, you
And
know?
this is 1,000% APR for a
Yeah,
week. Yes.
yeah, for a week basically. Yeah, then it goes down
Okay.
to like 300 or 100% a year, which is still not shabby, but
Yeah. Okay. 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 Hmm. I want to delve into the, the mechanics a little bit better. And also it just makes me. It's like I love the analogy of I don't know how an automatic transmission works in a car, but I know I put it in D and it drives and it's awesome.
Yeah.
I don't need to know how the transmission works to drive the car. I don't need to know the
Oh,
answers to the questions I'm about to ask. I'm going to ask them because I'm a curious guy.
yeah, sure.
Okay, let's stick in the world. Let's just go to stablecoins, and we talked about 20% return on your stablecoins APR. I'm thinking, and again, the way we earning our money, they call it a yield, but they're not just paying an interest rate. It can go
No.
up or down. What they're doing is they're sharing the fees that are earned trading on the DEX.
Yep.
So I'm picturing a centralized exchange like Coinbase. They're, multi-billion dollar company. I think they're a multi-billion dollar company, listed on the stock
They
exchange,
definitely are.
and they're making all kinds of fees just trading. And this reminds me of the gold rush analogy. It's like when there's a gold rush, you want to find a way to sell the picks and shovels because most of the guys
That's
looking
me.
for gold are going to be broke.
Side of the road.
So there's Coinbase, there's liquidity providers, there's all these. It's a gold rush. People are coming. I want to trade crypto. I want to be the next billionaire. So they're all trading, trading, trading. You're selling picks and shovels and say, okay, well, you want to trade? Here's you can either do it at Coinbase or you can do it at this DEX. If you do it at Coinbase, Coinbase get the fees. If you do it on
Yep.
this DEX, I get a portion of the fees. And there's really no limits. Like when I hear yield, here's the mindset I'm trying to break in myself, that I'm trying to help the people at home watching break. When you say yield, and especially when you use the analogy of a bank account, I give the money, bank, I know what I'm saying is not technically true, don't hold me down, but that's the mindset. You give your money to the bank and the bank lends it out.
Right.
I know, just in case there's people jamming on the comments, I know the banks create money when they lend it out, but
Yeah, I know that
I
too.
know that very well. Don't worry about that. When I lend the money bank, they lend it out. If they lend it to people who can't get it, sorry. If they lend it out to people who don't pay it back, without a government bailout, the bank goes bankrupt and I lose my deposit. That's what I think of when I'm earning a yield and I'm lending money to a bank deposit-like scenario. But that's not what this is.
No.
This is funding a liquidity pool like a Coinbase, and they are sitting there when people are making money every time people make a trade. They buy a Bitcoin, they make money. They sell a Bitcoin, they make money. They're charging fees for a service they can't perform without you putting your coins into the liquidity pool, and they are paying you handsomely to put your coins in that liquidity pool so that they can provide the service, so that they can provide the fees, and they share the fees with you. There's no limit to the amount of fees they can charge.
No.
They're not lending the money out and hoping someone pays it back. It stays in the pool. The only time it leaves the pool is if someone, let's say it's an Ethereum Bitcoin trading pair, Ethereum comes in, they send the Bitcoin out. Or vice versa, Bitcoin comes in, they
Yeah.
send the money is not being lent to another party and hoping they pay it back. That is not happening here. It's sitting in the pools. Traders are trading it. Pools are going up and down, back and forth. Da, 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 da. They're charging a fee every time someone wants to trade, and they're sharing those fees with you. no theoretical ceiling on this amount of activity. If all the other liquidity providers withdrew all of their liquidity and you were the only one in the pool, and if there was a huge liquidity trading spike, millions more traders came in, I mean, you could be earning 10 gazillion percent.
Yeah, all of
Right. Now,
it, everything.
obviously that's not going to happen. So what
No.
happens is more liquidity providers put their coins in. They see you making a gazillion percent, and that chases down the fees that you get. But as long as there's this, look, this is not easy. This is look, it's not hard, but it's not common. Let's say it's not common knowledge, right? People are at home
Not at
busy.
all.
They're learning their business. They're trying to figure out how to make
Yeah.
ends meet. They're trying to earn their paycheck. People haven't got time to understand this profit center in this business. But if you do have the time and energy to come in and do it, it's not hard, especially with your course, it becomes quite easy. You can
Yeah.
come in, you can understand it, you go and park your money there. And what you're saying is right now, with the current levels that I just described, the amount of trading going on compared to the amount of money in the liquidity pools, the figures you've quoted are what people are earning now. That could go up, it could go down, but right now that's what's kind of happening. And there's the opportunity that is available to everybody if they take action now. Everything I said
Yeah.
is accurate so far?
Yeah, it's accurate. I mean, what you described with the banks, that's more of the crypto lending side of yield farming, which I don't do because liquidity mining is so much more lucrative. I was actually picking between the two. I'm like, should I teach people crypto lending on like Aave and all these platforms where you lend out your crypto to people and you get like a fixed return, whatever, 20, 30%, right? But liquidity mining, that's not the case. There's no limit, like you said, and the more volume comes into the dexes, the more fees you make. Plus, the more money the dexes make and the larger the competition between them, the more liquidity incentives they provide, which is another source of reward. Sometimes even bigger than the fees, like 6 to 7x larger than the fees. That's because they're all competing for the liquidity providers, and they want to motivate you to go with them. So they're like, oh, deposit your money with us, like provide liquidity with us, and we'll give you this token and more fees, and so it becomes kind of like a game that you play. And I've been playing this game for a while, put it this way. But yeah,
Let me
not many people know about liquidity mining. That's like a totally hidden thing. Most people are aware of crypto lending, because Avi did a good job of promoting that. But liquidity mining is super like niche, and not many people know about it. That's my mission, to bring that to everybody, because there's a lot of money to be made. They're handing out free money, people, on the dexes. Like, come and get it. Come on, free money.
let me explain that dynamic to people because I think that's really, really interesting as well. It's a competitive world and there are lots of dexes. And they're
Yep.
all trying to get traders to trade on their dex and not the other guy. The same way Coinbase wants people to trade on Coinbase and not Kraken. In
Yep.
the decentralized land, it's exactly the same thing. What a trader wants, I think, more than anything else, is lower fees.
Yeah.
But there's a catch here. The way the liquidity pools work, the bigger the pools, the smaller the slippage. Advanced language, but the bigger the pools, the larger transactions you are able to make and get a good price. If you have a small pool and you try and make a trade, what happens is something called slippage. The trade actually moves the pool so much that you don't get the price you wanted anymore. If it's a really big pool, then you can have quite a large transaction. It's like throwing a boulder into the ocean. It doesn't create waves across the other side of the ocean. But you throw a boulder into a little pond and you wreck the pond. There's waves everywhere. So what these dexes are trying to do, they're massively incentivized to say, hey, liquidity providers, come give your money to me, not that guy. Because if he's got a bigger pool, he's going to be able to do his job and service traders with lower fees and lower slippage. And it's the bigger pool has bragging rights, has advertising capital, not as in
Yeah.
spending the money, but as in bragging rights, right? And the third, and then you're also taking liquidity away from your competition. Hence, these dexes are very incentivized to take very good care of their liquidity providers and offer incentives and bonuses and rewards. And what you're revealing is sometimes the rewards means you 6x your return, and the bigger return wasn't the yield, it was in the rewards. Is that correct?
Yeah, that's usually the case actually, because
Okay.
it's like 6, 7 times more than what you get in fees. At some places, obviously. When the volume spikes, then it shifts the other way. Obviously, then the fees become crazy, and you collect that plus the rewards. So it's like it's all good news for liquidity providers though. Like in that
Gotcha.
situation, all good news.
Okay. All right. Now I'm going to ask some personal-ish questions. I hope you're comfortable answering. How many years have you been doing liquidity providing for these liquidity pools?
About 5 years now. Yeah.
5 years. How many individual transactions have you done in that 5 years, would you say?
What do you mean individual
What,
transactions?
thousands, tens of thousands, hundreds?
Oh, you mean for
How many times have you lent
managing?
money and taken it back out?
Usually I just put it in there and I check once a month. Like I just to collect my yield. That's it. Just to collect the rewards. Yeah.
And then
I
and
most
and you just leave it there.
just leave it there. Yeah. I don't do much. It's like maybe 10 minutes of work per week, if not per month. So it's not like trading. Like you just basically, select your pool, you put your fund. If it's a stable pool, then I could check it like once every couple of months, because I know it's not going anywhere. It's just literally just to collect the rewards and send it to my bank account. That's it. I use them just to basically make dollars. That's kind of like a job replacement scenario where you just make the money, you don't care, you just cash it out, exchange it, send it to your centralized exchange, put in dollars and right to your bank account. Yeah. So unlike trading, this is very like low touch. Once you learn this stuff, it's like riding a bicycle. Once you learn it once, you get it, and that's it. You're good. Then you just need to, see if there are any better pools out there. You can shift your farms if like, let's say they spin up a new pool and you see, oh, there's a lot of activity going on there, and I like those coins anyway. So you just kind of take your money out and put it into that one. It takes like 5 minutes, and that's it. And then you don't touch it anyway. And sometimes I just look at my phone, just to make sure everything is, in place and how much I'm making. Yeah, so it's
Gotcha.
very, very low maintenance way.
All right. Let me ask a better question here. How many does it do you lend in pairs or do you lend in coins?
You land in pairs,
You lend in
basically.
pairs.
You always select two coins that you want to provide liquidity in between.
Over the 5 years, how many lending pairs have you lent to?
I literally just use swap like in the last, I think, 4 years, and I think I have like 6 or 7 pairs. That's it. So
Six
I'm
or
very
seven pairs.
concentrated. Yeah, I'm very concentrated. A lot of
You're very
people
close.
they go multiple networks, multiple dexes to really like diversify and make it safe. But I mean, I know swap. I know the team personally. I met them at like Polkadot events, so I'm very confident in what they're doing. So that's why I promote it. That's why I put my face out there. Obviously, if I thought there were scammers or anything, I would never risk my reputation, for obvious reasons, because I've spent a long time building it up and working on this. Yeah, so that's kind of my strategy, but doesn't have to be your strategy. You could do the super diversified, multiple dexes, multiple networks, like Avalanche and Solana and Ethereum layer twos and like Polkadot. There's multiple parachains. I don't know. I just like Moonbeam on Polkadot because I trust Polkadot security and I trust the Swap team. And so far, they haven't led me astray. Put it this way. Yeah, I like
Okay.
it. That's my favorite.
So over the course of 4 years, you have had money in 6 or 7 pools. You just left it there. You take profits out,
Yeah,
but you basically just leave it there.
I just leave
All
it
that
there.
time.
Yeah, long term, I don't care.
Yeah. So in all that time, so this is a very long term thing. In all that time, so have you ever lost? Have you ever suffered like realized impermanent loss or suffered loss of any kind?
There, in the very beginning, I did lose because of bridge risk. What I was talking about.
Yeah.
Basically, I don't know if you remember the Nomad bridge imploding. Basically, it was an employee issue. Some guy had all the keys to the bridge, and he just literally just stole all the money from the bridge.
Yeah.
Yeah. So I lost a bit on that, but that was the bridge risk what I was talking about. You guys don't have to deal with that anymore because back in those days there was no native stablecoins. That was the biggest issue. And
Hmm.
that's why I suffered that loss, and it was okay. I made that money back and then some, so don't feel sorry for me. It happens. This is crypto. But now they have native stablecoins. That's it. Like you're not gonna have to deal with that anymore. That's why as soon as you get the money over there, you swap it into native stablecoin. Boom, you're safe. Those bridges can burn. Like you don't care. You're not using that. Like your money is not in the bridge. Your money is now on Polkadot, secured by Polkadot, which is, obviously way better guarantee than any bank, in my opinion, because Polkadot security is a beast. Like, yeah. So yeah.
Okay. Okay, cool. So in the early days, because of the wrapped coins, because of that
Yeah,
bridge risk, there was
goddamn
loss.
rep coins.
But in the current model that you've been using for the last, I think, 4 years, they're no haven't suffered any kind of losses, any kind of
No,
failures of protocol, because we
nope.
still have protocol risk, right? I mean, no failures of protocol at
No,
all.
no. Tell us
And
what
even
did over
and
2
even
billion in volume. I mean, with no
even
problems.
in even so impermanent loss, that is a risk that people can have. That's if they've taken their money in and out and back and forth. You
Yeah,
may realize some loss. You've just taken this idea of I'm just leaving it there for 4 years. I'm a
yeah.
hodler. I'm holding these coins long term, and you're happy with the results and not suffered any impermanent loss.
No, I mean most of my stuff is in stablecoin farms, newsflash, like 80%. The rest is in like I play with the exotics, like I was saying, the third bucket, I chase those little pumps on the volume, with like 20% of my money. But 80% I just put it in stable farms, I just forget about it. I don't care. You
So
know?
wait, so now when you say stable, neither of your two assets, neither of the two assets in the pair, they're both stable coins. Is that what you're saying?
Both stable coins. Yeah. There's like
Both
an
stable coins.
USDC, both stable coins. USDC, USDT pool. Like 20% you can get right now. Yeah.
20% right now.
Yeah.
Historically, what has it been? Is that number trending down, trending up?
It's basically the way it's calculated. It's in real time. It depends on the rewards and the volume for that day, basically, and how many people are in the pool. So, like most people, when they ask me, "What's the APR?" I'm like, "You mean like this second?" Because it changes in real time.
Yes.
It could go up to 100%, then it goes down to 20, then it go up to like 9. Depending if there's like no volume, rewards are low, then it goes down. But over a long period of time, you still, and mostly what I recommend is you diversify between the 3 buckets. So you put like, for example, and it depends on your risk tolerance, right? If you're like super risk averse, just put all of it in the stable farms, and that's it. Then you can sleep
Yep.
at night. You don't care. Like you just check once a month, collect your rewards, go on your way. If you're like me and you have some risk appetite, you can split between the 3 buckets. Put some into stable bucket, put some into the blue chips, and put some into exotics. And it kind of blends into a nice little APY overall. That's kind of the strategy that I teach to
Gotcha.
people. Some people go crazy. Some traders, if you can chart the price nicely of a coin and you know where it's going, then you can put like all your money into like the third bucket, the risky bucket, right? And you can concentrate to that price range because you know what price range is going to be, operating in that coin, right? If you're a pro trader, then you can make crazy like 800,000% a year returns, high risk, high reward. So it's like you basically control your own things. First, you control through selecting the bucket. That's the first control. And then you control the range. The tighter the range, the more fees you get because you concentrate your liquidity into that super usable range where everybody's trading. So obviously the fees can 10x, and they actually give you the rewards also based on your range. That's another thing that people don't know. Like
Explain that.
the dexes, they see your range. If you're always in range and you're super tight, they give you a larger percentage of their incentive rewards as well.
Ah,
So you get both. Yeah. So they kind of synced it up. That's they only did that a year ago because people are complaining like, what do you mean? I'm on the tight range. I should be getting more of those rewards, not just the fees. And they're like, okay, we'll do that. And that's because I think that's fair. If you're taking more risk, you should get more reward. That's just fair. Versus
gotcha.
me, if I go a little wider, because I don't want to be knocked out of range. So yeah, it's different strategies basically. Tighter range, more fees, but you could be out of range more time and not collect fees at all. Or you can make a wider range, which is, less yield, less reward, but
Yep.
you're in range more of the time. So you collect fees longer. You see what I'm saying? So it's like, it kind of offsets each other.
Okay.
Yeah.
Understood. Now you mentioned stablecoins. I've heard you say Ethereum, Solana as your top 10. But that was that middle tier bucket and exotics. I haven't heard BTC mentioned. Can you do BTC?
Oh, well, Bitcoin is blue chip. Yeah, it's in the second bucket for sure. Yeah,
Oh,
Bitcoin,
okay. So you
Ethereum.
can.
Yeah,
You
yeah.
can
Yeah, of
deposit.
course.
You can deposit native Bitcoin into these pools.
Native Bitcoin, no, that one is wrapped. You do have to use I can't remember. I think that no, there's no native Bitcoin on Moonbeam. Not yet anyway. I think they're working on it.
So
But the
okay.
stable
So
stable coins are
if you
native
want
so
Bitcoin,
far.
then you're going to introduce bridge risk.
Yeah,
But
yeah.
if you do
That's
Ethereum,
yeah.
or
Yeah.
Polkadot or like
Yeah.
Solana, you
I
can do all
think
of those.
ETH. I think ETH XC is there. Yeah, native Ethereum is there. It's just the problem is it's a Moonbeam is an EVM compatible parachain, So it's not Bitcoin compatible. You know, obviously nothing is. It's Bitcoin is Bitcoin. But I think they have I don't know if they still have that. There's a native Bitcoin through interlay parachain. There you go. Yeah. So they do have native Bitcoin. Yeah, that's right. I don't know if they still have a pool for that, but I gotta check. You know, I'll get back to you on that. But yeah, I think they were doing something with interlay parachain, which is like a whole vault system where you deposit your Bitcoin in like a decentralized vault, and then they issue you like a BTC dot interlay token, you know,
Yeah.
and the vault, unlike the bridge, is decentralized. So there's a whole slashing mechanism and the collateral. You're probably aware of things like that. Yeah, so that's how they tried to get around the bridge problem for Bitcoin. You know.
Okay. All right.
Yeah.
All right. I appreciate that, Vadim. Let's leave that there. Guys, if you like this, like and subscribe to the channel. We'd love to have you stick around for interesting conversations like this. In the link in the description below is going to be a replay to the webinar that Vadim and I are doing. By the time you watch it, did. Highly, highly recommend you watch that. Vadim has a whole presentation that he goes through the whole process in more detail, and then at the end of that offers you the opportunity to buy his product, where he'll actually coach you through the whole process, make it all really easy for you. So go ahead and check out that replay right now in the link in the description below. Vadim, thank you so much for being here, buddy.
Thank you for inviting me. Glad to be here.
Cheers. Bye.
Bye.